The following program is a special presentation of the Big Ten Network, produced in association with the University of Wisconsin.
A year ago, every day seemed to bring more bad economic news, and many experts feared full financial collapse and even a Great Depression. While many Americans are still hurting, the news seems better now. The stock market and home sales are up, and there is a sense that the U.S. economy is out of intensive care and on a slow path to recovery. We'll discuss the current state of the economy, grade President Obama's economic team, and identify future challenges with two experts from the University of Wisconsin next during office hours. I'm Ken Goldstein, Professor of Political Science at University of Wisconsin-Madison. Today, we're taking a look at the economy and the economic policies of the Obama administration. Joining me are Karl Scholz and Morris Davis, both accomplished scholars who have also had extensive experience in the policy world. Karl is a professor in the Department of Economics at UW-Madison and served as a Deputy Assistant Secretary of the Treasury in the Clinton administration. Morris is a professor in the Real Estate and Urban Land Economics Department, and before coming to UW-Madison was on the senior staff of the Federal Reserve Board from 2002 to 2006. Morris, Karl, thanks for joining us on Office Hours. Always a constant stream of economic news and economic data. This past week has been even more than most weeks. Karl, sum it all up for us. Where do we stand now? Where are we now?
The big news is GDP declined by about 6% in the first quarter of the year. This most recent quarter, the estimates are for about a 1% decline, and many forecasts predict that we'll have positive growth the rest of the year. The other measures of the economy that we look at, credit markets seem to be functioning again. During the worst of the crisis, there's something called the difference between the interest rates that banks charge on loans between each other versus short-term government debt was 4.63 percentage points, the difference in those spreads. And that is essentially credit markets were locked up. That's now down to 0.2 percentage points. Unemployment rate 9.7%. A year ago it was 6%, so the unemployment rate is continuing to go up. It will go up further. It's a lagging indicator, so that's a problem. On the other hand, the stock market is up about 40% from its lows. That's still down about a third from its peak, but the market's doing well. Lastly, the big news this week is deficit projections. They're expecting a $9 trillion deficit over the next 10 years, or about 5% of expected GDP. That's a big and worrisome number. So considering where we've been, I think there's some good news, but there's plenty for those who are inclined to worry about.
Okay, so we're gonna tackle a lot of these points and a lot of these pieces of data that you've given us. Let me ask you the same question, Morris. Are we out of the emergency room on a slow path to recovery now? What sorts of indicators are you looking at?
Well, I'll tell you this: short-term forecasting is very hard. A year ago, nobody would have predicted that we would have just gone through the spell that we just went through, where unemployment rates shot up to nearly 10%. We had thought that those kind of unemployment numbers we were never going to see again. So there's always some uncertainty around some forecasts. Rather than talk about the real side, which I think Karl did an excellent job laying out the numbers and talking about forecasts on the real side, I'll talk about some prices that we care about. I think that house prices have bottomed or are near bottom. So I believe that we'll hit bottom for house prices either this fall or in January 2010. And I say that because there's a statistic that I look at for house prices called the ratio of rents to prices. That has some background in finance as being some metric that you should study to tell you about returns going forward. And right now, the prices have fallen so far that the rent-price ratio is now at its historical average of 5%. So the rent-price ratio was 5% from 1960 to 1997. Between 1997 and 2006, the rent-price ratio fell from 5% to 3.5%. And since mid-2006, house prices have fallen by enough so that we're now back to our historical average for prices. So if prices stabilize, then maybe that's good news for the rest of the economy.
So this other piece of good news we've also seen new home sales also have a much larger increase than people had expected. That happened this past summer.
Yes.
Just a function of prices are so low, bottoming out, pent-up demand?
Probably all those factors. There's still a lot of excess inventory in housing, so I think we had a big growth rate off of a low level. And we'll just have to work off the excess inventory of homes, and that might take a few years.
Let me, the White House put out a report and forecasting debt and deficit and GDP growth over the next year and over the next 10 years, and they summed up the current economic situation. While the danger of the economy falling into a deep recession has receded, the American economy is still in the midst of a serious economic downturn, and the long-term deficit outlook remains daunting. Many points there, but two main points. One, things were pretty bad before, and two, going forward, we still have some serious issues. How bad was it last year at this time?
I think it's really easy to lose sight of just how precarious a situation we were in. Even at the beginning of the year, the cumulative job loss over a 3-month period was the largest it had been since 1945. The second largest had only been half as large. And so we were in a very extreme position. Credit markets had completely locked up. The options markets said that there was a 1 in 6 chance that the stock market, that the Dow Jones index would be below 5,000. And so we were on the edge, I think, of a major economic catastrophe. Kind of what else you'd look at? You'd look at the Great Depression in the 1930s or the so-called lost decade in Japan. And given those circumstances that were so far out of the norm of normal business cycles, the very aggressive action that the Fed took and the administration and Congress, I think, was warranted.
I'm going to interrupt you there. When I come back, I'm going to ask Morris to assess what the situation was at this time last year, and then we'll get into a discussion exactly what the government did, what the Fed did, and did it work. I hope you'll join us as we continue our discussion on Office Hours.
This program is a production of the University of Wisconsin-Madison. If you have comments about this broadcast, please email them to programming@uc.wisc.edu.
For more than 100 years, the University of Wisconsin has been inspired by the Wisconsin idea,
which says the good work of the university extends to the boundaries of the state and beyond.
So the UW works hard to help build Wisconsin's economy.
Educate people of all ages.
Advance health and medicine.
And enhance the quality of life for all of us.
Hit it!
The University of Wisconsin-Madison. Forward thinking.
Welcome back to Office Hours. We're discussing the current economic situation with Morris Davis and Karl Scholz. So Morris, we're just talking with Karl about how bad exactly the situation was last fall. What's your read on exactly how bad the situation was?
It was terrible. For financial firms, it was terrible. You could argue, the people I know in the financial industry basically thought their world was about to end. So where the debate is not...
Were they right?
Well, where the debate is not whether or not the financial industry would have collapsed, but what would have been the spillovers to Main Street. And that's where there's honest debate in the profession. There's a group of people out there that they think stock prices are basically unrelated to what goes on in the real economy, GDP growth, et cetera. And then there are other people that say, no, there is a fundamental link. And because the profession itself is uncertain, there's debate among otherwise reasonable people about how bad it was and what the spillovers would have been from the financial sector to the real, so-called real side, or jobs and employment. And
so if you were still in Washington, D.C. at the Federal Reserve and AIG called up and said, we need a bailout, what does Morris Davis say?
No. Morris Davis said, I don't want to talk to myself in the third person, but I would have said, I would have said no. People in the financial services industries are paid to take risks. So if the risks don't pan out, they should go under. That's supposedly the heart of the system. If all of a sudden we can't have financial firms going under because some risks are too big or whatever, then we have to completely rethink the compensation structure and the role of government in these industries. But if our stated position is that people take risks, they're paid for taking risks, and sometimes those risks don't pan out, then you have to let firms go under. And so people point to AIG, saving AIG. In the financial services sector, they say if we didn't save AIG, the financial service industries would have collapsed. That's where I'm not certain. I'm still under the impression that we should have let AIG go under, and whatever else happened, Goldman Sachs or everyone else would have gone under after that, and then figured out what to do.
Okay. So Karl, if you're still in the Treasury in the Clinton administration and you get the call?
I agree with much of what Morris says, that you need to, if you get into a situation where financial firms are too big to fail, the incentives for firms to misbehave are pretty substantial. I don't know enough about the specific case of AIG. I do know that the policymakers let Lehman Brothers fail. But the thing that I want to emphasize here is that the events of the past year are not just a Wall Street phenomenon. The effects have been felt on Main Street. GDP growth had the largest 6-month rate of decline since 1958, and that is felt on Main Street. And so this is a case when credit markets lock up and there's extreme turmoil in the financial sector, it filters down, and people are feeling it not only in their financial portfolios, their 401ks, but also in their jobs. And that's why such massive intervention that the Fed undertook and that Congress and the administration took, I think was necessary. Surely there were errors that were made, but those errors were made because they were working on a situation where there wasn't a playbook. The circumstances people were dealing with were so far out of the box that you're having to make it up as you go along. And in an imperfect political democracy like ours, there'll be mistakes that were made.
So let me interrupt just
Sure.
for a second. We've had big recessions before. Obviously, we had the Great Depression of 1929 where unemployment rates hit 25%. And everyone was concerned that the sort of shock that we had was enough to cause a second Great Depression. But we have had big recessions before. We just haven't had them for a while. We had a very big one in 1973 and another very big one in 1982. So the question we had to ask is, before we take an enormous policy intervention, because we say we haven't seen this before, we have to ask, have we really not seen this before or not? Now, I agree with Carl that there are many things we hadn't seen before, such as the decline in house prices leading to a collapse of mortgages, leading to the insolvency of the financial sector. I agree we hadn't seen that before. But we've seen big recessions before.
But the second thing that's happened now is sort of the interconnectedness of companies kind of around the globe. And so we saw a perfect storm where every sector, housing, the financial sector, economies around the world were also in peril. And with the greater interconnectedness, I think that made the circumstances considerably more dangerous than the 72 and early 80s recessions. Again, the 6-month GDP decline was the lowest since '58.
But the only thing that we've done in the process of intervening, we've created a situation now where basically financial firms can't fail. So there was always that risk in Freddie Mac and Fannie Mae that they might fail, and that maybe there wasn't any risk, but you would argue that imposed some discipline on their behavior. There's no discipline now on the behavior of financial firms.
I'm going to jump in here. We're going to go to break. We'll continue with this and then talk about exactly what the intervention was. Please stay with us as we discuss this and even have a little disagreement on office hours. Welcome back to Office Hours. Just before we went to break, we were discussing whether the government actually did need to massively intervene last fall. And Morris, you were making a point that there's consequences to having banks that are too big to fail. Why don't you finish up that thought?
Well, there are banks that, in the absence of government intervention, that probably wouldn't exist today. One of those is Goldman Sachs. I think I can state that with certainty. So now Goldman Sachs knows implicitly or explicitly that they're not going to be allowed to fail, and that should change their behavior. They might engage in riskier behavior, and they might pay out bigger bonuses. They might just behave differently than if they thought there was some chance that they'd be allowed to fail and management would change hands.
Quick thought on that, Carl?
Morris raises an important point. I'd make 2 points. One is that Lehman Brothers did fail, so there are financial institutions that failed. Second, and more importantly, though, is going forward, we need a regulatory framework that curbs the excesses that would happen when companies engage in the natural incentives that Morris is talking about. So Morris is raising a very important point. The answer is to set up the financial structure in a way to discourage that.
And like many topics, we could do a whole show on
Absolutely.
that. Let me stop this discussion and make the point, disagree about what we needed to do. The fact is there was intervention. What exactly did we do? You want to take a first crack at that, Morris?
Sure, I'll talk about the actions of the Federal Reserve. There was traditional monetary policy and non-traditional monetary policy. The traditional monetary policy was the Federal Reserve took actions to reduce the cost they reduce the interest rate that banks pay on their reserves. Okay, so that's traditional monetary policy stuff. What they did that was untraditional.
Cheaper for banks to borrow, easier for banks to give to all the rest of us.
Right, that's the idea. The The other thing that they did, which was basically unprecedented, was that they securitized, or they tried to make as risk-free as possible many forms of debt. So they just greatly expanded the volume of debt that we'd consider to be risk-free. They also expanded the amount of reserves that banks could lend. So one of the responsibilities of the Fed is to promote liquidity among banks. And you could argue that there was a liquidity freeze in October and September last year, and that all these actions were done to promote liquidity in the banking sector.
Okay. Also, there was a stimulus package.
The administration and Congress passed a really massive, by historical standards, stimulus package. Some of it seems maybe a little bit sketchy or dubious policy making. The most recent example that's been in the news is the so-called Cash for Clunkers program. But nevertheless, the bulk of the stimulus package was for stuff that I think most listeners, and certainly around the table, we'd probably agree makes a fair bit of sense. There was a tax credit for working families with incomes, individuals under $75,000 and couples under $150,000, just getting cash in pockets to people who would likely spend it. And then there was at least a couple $100 billion of aid to the states. States, as you know, are in very, very tough fiscal circumstances. And so aid to the states has a quite stimulating effect because the money
And
gets
unlike
spent.
the federal government, the states can't run deficits.
Correct. Almost all states have balanced budget amendments. And so a lot of things, unemployment insurance was extended, food stamps, money went into food stamps. We extended, or we put a lot of money into highways and bridges, a lot of things like that. And that, I think, certainly reasonable people can disagree, but an awful lot of economists who are observing this are saying that this seems to be having a modest positive effect. And so when GDP growth has only fallen 1% this quarter, 6% last quarter, part of that is likely due to the effects of this spending package.
So using my non-economist language, we created a lot of money and threw a lot of money at the problem. That's going to have some long-term consequences. When we come back on Office Hours, we're going to talk about what some of those long-term consequences are and what some of the dangers are still in the real estate market and other elements of the United States economy. Please stay with us.
For more than 100 years, the University of Wisconsin has been inspired by the Wisconsin idea,
which says the good work of the university extends to the boundaries of the state and beyond.
So the UW works hard to help build Wisconsin's economy.
Educate people of all ages.
Advance health and medicine.
And enhance the quality of life for all of us.
Hit it!
The University of Wisconsin-Madison. Forward thinking.
This program is a production of the University of Wisconsin-Madison. If you have comments about this broadcast, please email them to programming@uc.wisc.edu.
Welcome back to Office Hours. Morris, want to get your quick thoughts about what the long-term consequences are of the money we spent and the money we printed.
My concern is that we're going to, with rising deficits, and that if we don't raise taxes fast enough, that we might have inflation. And with the deficit rising, one way to fund the deficit is to print money. By printing money, you have the potential to create inflation. And I think we should all be concerned about that.
But Carl, another concern is we don't want to take our foot off the gas too quickly. There's some evidence that in the Great Depression, we did take our foot off the gas too quickly, and if it wasn't for World War II, it would have continued on. Thoughts on that?
At some point, we're going to have to tackle the long-term fiscal problems. Doing it too soon would be a terrible thing to do to the economy. So that's a huge art, and the policymakers are going to have to navigate about what's the right time to do this. I think Morris may have some thoughts on this, though.
Yeah. On the right time to raise interest rates?
Yeah.
Right. I don't have any thoughts on that.
I'm sorry. I'm sorry.
Talk to me about, so we just talked about some long-term dangers. You're also still really concerned about the real estate market in the short term and some policies we're not implementing. Talk to me about that.
That's correct. So I'm very concerned about foreclosures because the people that are being foreclosed on now did all of the right things. They were the prime mortgages with 20% down. They're getting foreclosed on because they've become recently unemployed. My concern is that all of the proposals that have been put forth by the Obama administration, at the end of the day, they do not help the unemployed make a mortgage payment. So the Obama administration's proposals are not helping the people that are about to be foreclosed on that did all of the right things.
Not speculators, not people who were flipping, not people who bought a house that was too expensive.
These are people that did the right things and had some bad luck. And this is why we have a safety net. We have a safety net to help people that did the right things and had some bad luck.
So quickly, what should we be doing?
We should be, well, there's two plans out there. There's one by the Boston Fed and there's one by my group at UW. Both plans help the unemployed by giving them some kind of temporary income assistance to supplement their unemployment insurance. The UW plan sends them a housing voucher, which they can use to make a payment on their mortgage. The Boston Fed plan gives them either just cash in the form of a grant or as a temporary loan. Either plan would be better than the so-called HAMP plan currently being proposed by the Obama administration, in the sense that both plans help the unemployed now make a mortgage payment.
So the effect of job destruction on the economy is also that those folks who are unemployed then can't afford their houses, and then it has this greater ripple effect. And so you have a plan which you think can get at that a bit.
We think either plan would prevent somewhere around 500,000 households from being foreclosed on. And we view that as something worth trying to prevent.
Carl, about the last 90 seconds that we have here on office hours, what are your thoughts on some policy things and some challenges we should be thinking about?
Yeah, looking forward, what I'm going to be looking at and what I encourage citizens to hold their elected representatives' feet to the fire on, really focus along these long-term deficit issues. And I think there's four things that I want to focus on. First, health care. There's always the moral issues with health care about, but here it's an important economic issue in that the driver of these long-term deficits are increases in health care costs. There's huge variation across the country in the amount we spend on health care with no discernible differences on outcomes. So we can do better. Second, we need to have a serious conversation about taxes. In previous presidential administration, we fought 2 wars. We implemented a prescription drug benefit. We had a massive tax cut with nothing being paid for. And that's sort of Santa Claus economics. We have to do better about it. And so we need to either cut spending or raise taxes. Third, we need to regulate and engage in trade with a light touch, international trade. Our financial system and the economy is tremendously efficient, and one way to throw sand in the gears of that is through regulation. So we need to regulate in a sensible way that that respects the market.
Let me do 4 quick.
Yeah, lastly, let's give people the opportunity to live up to their potential. So we need to pay attention to high quality education, job retraining, and the like. So those who aren't as privileged as I happen to be and others have a chance to make it.
Carl, Morris, thank you. From the University of Wisconsin-Madison, this has been Office Hours. Thanks for stopping by. Hope you'll see us again next time.
The preceding program was produced by the University of Wisconsin in association with the Big Ten Network.